All right, we're back. Back here. Can you hear me? Can you see? Oh, I have to put the video up. I'm not sure what happened. What happened? Having some difficulty. Now you see where we left off. All right, how's the sound? I find it overly sensitive usually. Okay, let's see who comes in. Share the link with them. I mean, it's the same. Oops, it's the same place it was. I'm in the same place I was before. Just a new video. Same playlist. How's everybody? You have a nice break? I had some potatoes and not much time for anything else. I didn't have much time. Okay, let's see if we can get back the 24 or so students from the morning. Or the earlier class. I'm not going to call it the morning. Do you have any questions? I'm just having some, I have to make some adjustments to my setup. There we go. I have to keep everything charged. All my components must remain charged. Not easy. I'll just wait for about 15 students. So I did send you these documents, this one and the other review. So I will send the solutions tomorrow, so you should work on them. Well, at least look at them. Work on them tonight if you have some time. I'm not sure your schedules, But we do have a class in the morning tomorrow at 9 a.m. All right. So every lecture I'll start a new video because we don't want a big video. It's already 3 hours. It's pretty long. Okay, so no comments, no questions. Shall we continue? I'll wait for just a couple more people. Okay, so we're 10 minutes. Okay, I'll just get started. Should I send the link to people? Or are they lost? Let's see, I'll just send that as a forward on the last email. Okay, well, let's get started. I don't want to wait too long for people. All right, I sent the link just in case that was an issue. People were waiting in the other one, I'm not sure. All right, so here we are. What did we do so far? So we made the timeline for $1,000 for 5 years, starting 4 years from today. So this is 4 years. 1, 2, 3, 4. So end of year 4 is 4 years from today. And then we begin 1,000 for 5 periods. So this collapses into this amount of $3,992.71. And then I discount that back for 3 periods. So I have this stored already. And now what I want to do is use it and discount it. I can do it mathematically, or I can do it using the time value of money keys. So what I would do is write 3 in N and then 8 in interest, and then PV is what I want, so leave it empty. And then there's no payments, it's just a lump sum amount. So you put, remember we were always putting 0 in payment when we were just moving single amounts through time. There are no payments here, just this amount back. And then what do we need next? FV is going to be 0. We don't put anything in future value. And we ask for PV. Oh, sorry, no, that's not what I meant to say. There are no payments, but FV is not 0. FV is this amount. So it's going to be recall 1 that I put into FV. Recall. Because I stored this value here, I can recall it now to use it for my calculation. So you should store it because it maintains all of the decimal places here. Again, you could do this easily using NPV and the CF keys on your calculator with 0, 0, 0, and then 1,000 for 5 years, but I want you to use the annuity formulas. I want you to practice using the annuity formulas. So let's do that. So in here, I have stored that answer. Now I'm going to change the sign and store it back in without a negative sign. What I want to do is enter 3 into N, 8 into interest. PV is what I want. There are no payments, 0 into payment. And I recall 1 and put this in FV. Then I ask to compute PV, and this is the answer. 3,169.54 cents. Would you like to see that again? Oh, we missed you. Severe? Just follow along, and I'll remind you that the formula sheet that summarizes what we've done so far was sent to you yesterday. So what we've done so far is summarized here. We've talked about time value of money, these two relationships, or these two formulas that use the same relationship. Then the net present value rule. This is the calculation for net present value. We talked about the perpetuity with growth, and then the annuity. And all that remains on this sheet is an annuity with growth. So that's why we're doing some review exercises. All right. Questions? So the final answer is 3169.54. And with your final answer, you round the number. All right? Any questions? You could actually also recall 1 and just divide by this amount, this factor, discount factor. Okay, how about the next one? Let me give you some time to draw it, and then we will discuss the solution. Okay, let's draw this then. So it does say, I want to make it, let me do this again. Starting 1 year from now, we will receive $2,000 for each of the next 3 years and $3,000 per year for another 2. So $3,000 for 3 and then, sorry, $2,000 for 3 and $3,000 for 2. So 2,000 for 3 and then 3,000 for 2. And the answer is this. Now you could use the NPV mixed cash flows to calculate this, but I want you to practice using the annuities. So what you have are 2 annuities. You have one here and you have one here that you will need to bring back to time here. Those are going to be our steps. So first we can calculate this part A, and then we can calculate this part B. B needs to be discounted back to time 0, and then we can add A and the discounted B. So for now, let me erase this line. And let's just get the 2 annuities. The first one is $2,000 at 10% for 3 years. That's the formula for that part. The second part, I'll call it the present value part B, is not at time 0. This will be 1 period before the first payment. So 1 period before the first one is here, time 3. And that is equal to 3,000 for 2 periods. So what we need to do is discount this one back here. Once we calculate it, we have to put it back here. So the point is, oh, and I forgot to mention that here, I can treat each value here, each position, each amount, this will be valued here at time 3 because the first cash flow is 1 period and so followed by a second one 1 period later. There are 2 cash flows. The value would be here using this formula. But it's not only is it the present value of these amounts, but it's also, you can see this as the future value at time 3. This is an amount from perspective here, looking out. There's an amount out here, this here. So at the same time that you can see it as present value 3, I could also see it, I could call it future value 3. I did it above without making too much about it. And then what I have to do is discount it for 3 periods. Treat it like a regular lump sum. So why did I do this? Because there's a lump sum amount. Let's calculate it. Let's calculate both of these and then we'll talk about this again. So let's see. To get this is $2,000 at 10% for 3 periods. So that's, let's clear our TVM, second clear TVM. So 2 periods at 10%, payments are $2,000. Did I just do this wrong again? It's 3 periods, right? Let's see that again. It's 3 periods? Yes, 3 periods. 3 periods of 2,000 at 10%. So it's 3 periods at 10%, 2,000, and I put a 0 in FE and ask for PV. So this is the amount of the first amount, the first A part. Oh, my sound. So that is 4973.70. So that's just this portion. So even though it looks like 6,000, it's really worth $4,973.70. It's important to know what things are worth so you can plan against those revenues. Okay, so next we have this amount, 2 cash flows at 3,000. What I'm going to do is mark it like this. That's where we're looking, the value. So this amount, 3,000 for 2 periods. So we'll clear, second, clear TVM, and for 2 periods at 10%, we have $3,000. I put 0 in FE and I asked to compute the PV. Now this amount, 5206.61, should also be stored. Oh, I didn't store the other one. So I'll repeat this in a second. So 5206.61. So this is 5206.61. I'm trying to put the comma. Okay, so this is the amount of these cash flows. So 2 amounts of 3,000 in present value terms at time 3 is worth 5,206.61. So what I need to do is discount that back to time. I'll just mark it here. I'm going to make it a little prettier. Let's see. So what I'm going to do is I'm going to do this over again. So let's repeat from the beginning, okay? What I'm going to do is store this value in storage 1. And then I'm going to store this value in storage 2. I'm going to recompute them. And then I'm going to use that here and store this result in storage 3. So you have to have some planning. And then I'm going to add storage 1 to storage 2, storage 1 and storage 3, because these are both quantities at time 0, and I should get this answer. You ready? All right, so let's do that. So we begin. Clear everything. Second, clear TVM. Let's do the first amount. There are 3 cash flows at 10% for $2,000 each. And I want the present value of the amount. I'm going to store that. I'm going to get rid of the negative. I want it to be a positive, and I will store it in memory 1. So I'm going to clear screen and start over with the second amount. The second amount is the part B is $3,000 for 2 periods. So 2 periods, I can do clear TVM. As long as I touch all the keys, I don't actually have to clear, but it's a good habit. 2 periods, 10%. I want the present value. The payment is $3,000. And I put 0 in here. And I asked to compute the PV. Now this is the second amount, 5206.61, right? So we're going to change the sign and store that in 2. So we've done this much. This we've stored in 1. This one we stored in 2. Now, I'm going to take the second amount and discount it back to period 0, and then sum these. Store 1 and store 3. So let's store. I said store 2, right? So now what I'm going to do is I can put that amount, recall 2, and put it into future value with no payments, with 10% interest, and 3 periods back. I can compute PV. So this is the amount that the 5,000 turns into, 3911.80, and I'm going to change the sign and store that in 3. So that is 3911.80. So let me leave this up. You guys can follow, or you can take a screenshot. And I'm going to give you the solutions to this. You'll have yourself to see. Can you even read that? Let me do it a different way. So this is 3911.80, and there are more decimal places. I stored them. I don't have to write them though to demonstrate what I'm doing. And now we're going to sum these two. Let's see. Let's see if I round it properly. So recall 1 and recall 3. Recall 1 plus recall 3 equals 8885.51. You see, if you keep all the decimal places, you get precisely my answer. 885.51. Questions? So why did I do this? This is supposed to be for you to practice with the annuity formulas. The annuity formulas and the time value of money formula. Okay, no comments? All right, so what I'm going to do is ask you to practice this last one yourself. The annuity due. Okay, so we can talk about it tomorrow if you have questions. Let me know if you hear me all right. Okay, so try this for tomorrow. The answer is here. Okay, I'll send you the solutions for this one and the other handout. So what I want to do now is get back to the notes and finish the notes. Do you have any questions for me? So what we'll talk about next are bonds. I did introduce the idea of the perpetuity, the consul bond, but bonds aren't usually structured that way. There are two other basic way bonds are structured that I will talk about. So what is a bond? Can someone tell me? So if you are a bond holder, You are a lender. You are lending money with certain terms to the loan contract. Okay, so the bond is written up as a contract. And with the bond, you get the indenture. And in that contract, it specifies the terms of the bond. It will specify the any interest payments that will be made on the bond to pay interest to the bond holder, right? The lender. So as I mentioned before, banks or, sorry, not banks, but corporations or governments issue bonds, it's also known as debt, to borrow money to finance their operations. So this is an example here of what's known as a discount bond. There are no coupons. Coupons are the word that's used for interest payments. All right? So this bond pays $1,000 in 5 years. If bonds of comparable risk have a yield to maturity of 6%, what is the fair price? All right, so this is a security. It's an investment instrument. And being as such, there's an interest rate we talk about here. There's going to be an I that we talk about, just like in the other problems. An I for a bond is known as the yield to maturity. Now, when we talk about bonds, it's possible that we loan money and we don't get our money back, right? So there is risk inherent with loaning money, and bonds of comparable risk. So if it's a corporate bond, maybe it's in a certain sector of the economy. So it's bonds from construction companies or like large conglomerate companies. So let's say you purchased a bond. In other words, you loan money to this company, and it looks like other bonds for companies, other companies in this sector have it or promise 6% interest. So that's the interest rate that should be used on this bond. So the interest rate is implicit in the bond pricing. Okay, so what that means is you will purchase the bond here at time 0 or now, and then at the end of 5 years you will get $1,000. So we've already solved this problem before, right? But now this is in the application of bonds. So if you purchased it here and you receive $1,000 for it here, how much should you pay for it if the implicit interest rate is 6%? What is the fair price? So this is just a problem of a basic time value of money. To figure this out, you just have to calculate present value of 0 is equal to the future value at time t over 1 plus I t. So that's the formula we're going to use. So it's simply 1,000 divided by 1.06 to the 5. Actually, let me put it. I'm going to write it a little neater. It looks messy. So the bond's price should be that amount. Now you could use the time value of money keys on the calculator, or you can just use the scientific keys, the regular calculator keys. So what you should do is enter 5 into n, n, 6 into interest, and PV is what we want, so we'll leave that empty. There are no payments, so 0 into payment, and into future value, enter 1,000 to be received. And here's your answer. Ooh, where is it? So as I explained, to put an answer, like in an assignment situation, I want to see the formula and the answer. This will not get you any points, but this is what I have to do to solve the problem. 5 into time, duration, 6 into the rate, PV is what I want. There are no payments, just a lump sum that I'm discounting. So 1,000 into future value, compute PV, and you get this amount. So what does it say? It says that the most you'd be willing to pay to receive $1,000 in 5 years is $747.26. And implicit in that is a 6% rate of return. This is known as a pure discount bond, because what happens is you get your 6% interest at the end. It doesn't pay you anything over time. You just get your 6% interest at the end. Questions? I'll allow you some time to calculate that. Okay, no questions? Now we're going to talk about couponed bonds. These bonds pay interest over time and then return or give you the $1,000. So we call this, actually I didn't specify that. So let me go back here to explain this a little more. So the terms of the bond include, what do the terms of the bond include? They include the the term to maturity. I need to use this terminology. So this is the time to maturity of the term to maturity. Not sure where to put this. So you would interpret N as the maturity is when the bond term ends. The interest rate we interpret as the yield to maturity. And the PV would be the price of the bond. The payment, if there is one, is known as a coupon. Oh my goodness. And the future value is known as the face value of the bond. So that's convenient, right? So this is the terminology when it comes to bonds. So Jeffson asks a question, for this formula T equals 5 years and not 60 months. Right, yeah, we're just using years. So I keep it simple. I will make it more complex later. So those are the features of the bond. And for this exercise, I've entered these values. There are no coupons on this bond. So we just recast the same variables with different names. Okay, so let's get on to coupon bonds then. This is slide 59. Okay, so that was what is known as a discount bond. This is a coupon bond. In a coupon bond, you get get intermediate payments, you don't have to wait till the end to get your payout. So here are the terms of the bond. You're told that there's a 6% coupon bond that pays $1,000 in 5 years. So you're going to loan some money, and if you buy this, and then you will get $1,000 in 5 years, and you're going to get coupons at 6%. What 6% coupon rate means is that this fraction, 0.06 of 1,000 or $60 is what you receive every period. And we see the periods as annual. So we have annual periods, and then we have the face value of the bond. So let me write that down here. So this is the face value. This is the term to maturity. This is the, or the T, let me put T. In the calculator it's N, but this is the, I use a little symbol C, and then I convert C with this formula into a payment. Okay? What else do we need? Oh, and this is the yield to maturity. So you have two percentages floating around. This one, for the coupon, tells you what the payments will be over time. This one, that is like the interest rate or the yield to maturity, tells you what your overall interest is, your return on the bond. So these are different portions, these are different types of percentages, okay? But what you'll see here, I've given you this example. This is called a bond or a par value bond. This is an example. This is an example of a par value bond. This is the case where the coupon rate equals the yield to maturity. When the coupon rate and the yield to maturity are equal, it means that you will get 60 every period and the 1,000 at the end, and in doing so you will have received your interest payments over time. And let's calculate this and then I'll make my point. Okay, so let's see, what is the value of this bond? What would an investor be willing to pay for this bond? So for this, what we have is two formula. So we're going to combine the annuity and the basic time value of money discount formula. Together, that would give us the price of the bond. Let me go back up to show you that. You see, you have these payments over time that make an annuity. But then you have just this single payment here. So we have formulas, but they don't, the only way to combine them is to add them. So we're going to add the present value of these to this. So we're going to have an annuity and a discounted $1,000. So here you have the formula. Here are the values inside of the formula. And it turns out, let's put this into our calculator and see what we get. So let's do that. So we have 5 goes into N, 6 goes into interest, PV is what we want. We put 60 into payment, and then we get to put 1,000 into face value. Notice this is the first time we use all of the keys. We put something other than 0 in all of the keys. I'll be receiving the payment of 60, so that's a positive, and be receiving the payment of 1,000, so that's positive. And now let's compute PV. And what do you find? So let's do that together. So I'm going to clear TVM and enter 5 into N. I'm going to put 6% into interest. I am going to put $60 into payment and the future value of 1,000. And ask for compute PV, and what do I get? I get 1,000. Well, what does that mean? Does it make sense that I would pay a price of $1,000 to get $1,000 back? Well, in this case, yes, because over the period, you'll be receiving your 6% return every period through the coupon, the interest payment. So that's fine. So when the face value is equal to the price, that's called a par value bond. And what you're getting is the interest payments over time. This happens when the interest rate and the coupon rate are the same. Thank you, Jeffson. Yes, you got it. Okay, so what if the coupon rate and the interest rate were not the same? What happens then? I'm on slide 62. I'll wait for you. Let me know if you have questions. All right, so in this problem, we have a C of 3. That's the coupon rate. We have $1,000 in 5 years. This is the face value, and this is the term. I want to keep it as T, duration of the investment. If bonds of a comparable risk have a yield to maturity of 6%, what is the fair price for this bond? So this acts like the I, right? We use C in this formula here together with FE, the fraction or the portion of future value, the 3% of future value is what we're going to get every period, $30. So you get $30, $30, $30, $30, and $30 each year for 5 years, and at the end you get the face value of the bond, the $1,000. So again, you have an annuity, and you have, notice I always draw the annuity all the way back one period before the first payment, okay? To remind me that that's where the value is, the valuation is. And then this amount, the face value. So what happens here? Well, for a 6% yield on a $1,000 bond, we were supposed to get 6% every period, or $60 every period. Now you get less. So what does that mean? You're getting less over time, so you need to be compensated. You need to actually get a boost. You need to get this at a discount in order to buy this bond. Not for $1,000. You should buy it for less. So it turns out, if you put this in your calculator, here's the formula. So I've put everything together. I use the annuity formula with 5 periods. 6% is the yield to maturity. That's the interest rate. $30 is the payment. And the face value is discounted 5 periods at 6%. You see, it'll only cost me $873.63 to get $1,000 in 5 years. That's a fair price. If it was offered for less than that, it would be a bargain to get it. Having said all that, if C is less than I, we call this type of a bond a discount bond because the price is less than par. So if you put this in the calculator using what we learned, 5 into N, 6 into interest, 30 into PMT, and 1,000 into face value, and ask for PV, you get the answer, 873.63. Discount bond. It's less than 1,000. Very good. Thank you, Anouk. Okay, I'll let you catch up. Any questions? All right, let's continue. What about the case where the coupons are more than the yield to maturity? So the coupon rate exceeds the yield to maturity. So this is the C, coupon rate. This is FV, the future value. This is T, years. And then the yield to maturity is this one, I. So it turns out here, I is less than C. And to figure out the payments that you receive in this coupon bond, you calculate 7%, 0.07 times 1,000, or $70. So this is the timeline. You get $70 every period, even in the last period, and then you also get the face value of the bond. So in this case, you're getting more than what we saw before, where we had a par value bond, where you got the interest was paid out over time, but here you're getting more than that interest of 6%. You're getting more than that. You're getting $70 rather than $60, so you should have to pay for that. Okay, you have to pay extra for that. So when you solve this, you will find you have to pay a premium. This is known as a premium bond. You're going to have to pay more than 1,000. All right. So if you were looking at purchasing a bond with these terms, then this is what you should be willing to pay. If someone offers you that bond for less, then you should buy it. Well, you'd have to compare it. You compare it against your other investment opportunities, but it looks like that would be a profit, right? Arbitrage profit, it's called. So here you have entering 5 into N, 6 into interest, 70 into payment, and 1,000 into future value, or face value. This is the annuity portion. This is the face value portion. Putting it into your calculator and asking for the price, you see the price is more than 1,000. This is called a premium bond. And you have a premium bond when the interest rate is less than the coupon rate. Okay, questions so far? Were you able to get all those? I'll wait for you. Got it? Can you let me know if you're fine? Should I continue? Please let me know. So in the test situation or an assignment, I expect you to write all of this out for me. This will get you no points. No points for writing this or showing me this. But it might help you in entering values. No points for presenting the keys. 1042. Very good, Anouk. Very good. Thank you. Well, what if now we have a formula for bonds, which is a combination of two formula, the annuity formula and the basic time value of money discount formula? What if we were interested in a different variable, not just the price? We've spent all this time solving for the price of the bond. What if we're interested in the yield to maturity for the bond? Now this is very practical because after a bond, just like stock, after bonds are initially sold by the company, they can be resold. Okay, so it's a contract or it's a certificate that can be resold on the market. So if you actually saw terms like this, where a bond, a 3% coupon bond that pays a face value of 1,000 in 5 years, was selling for $854.55, what is the yield of the bond? So you would, if that's what's being offered by a seller, what should be the yield? What would be the yield of that bond? So with that information, you can consider if that looks like it's right. Is that the right yield, or is that a risky bond? Should I expect a higher yield for that bond, just in case something happens to the issuer, bond issuer? Okay, the debtor. Jeffin is asking, what are premium bonds used for? Well, these are just different terms of the bond. I think it's a good question, but I'm not sure how to answer that. The premium bond exists when you're getting your interest payments at a rate higher than the actual yield on the bond. It's a good question. I don't know how to answer how do you use premium bonds. This is just how you solve for the value of them. But I'm sorry, I'll have to think about how to answer that better. I'll get back to you on that. So where were we? I was looking at, all right, so let's figure out a different variable. We're going to figure out the yield to maturity on this bond so that we can consider it against other possible investment opportunities on other bonds that we're looking at purchasing. So let's figure out what's the yield for this bond. So 854 is paid and you would get $30 every period. Uh-oh, I'm leaving accidentally. You get $30 every period, and then $1,000 face value of the bond. So let's put together everything we know about the bond in the formula here. So we know the price now, and we know everything, but we don't know I. Do you see that it would be difficult, or actually it's impossible, to analytically solve? It's impossible to isolate I on one side. It's a very complex formula. If you were to try and find I, you wouldn't be able to do it. You would actually have to use some sort of estimation technique where you pick different I's and you put them in and try and approach this number to find the right I. So this is a really important example of the usefulness of our calculator, or the finance calculator. This can easily be solved with the finance calculator. The only trick is that you have to remember that present value is a payout. You're paying, if you're a bond holder, you pay this amount and then you receive these amounts. So this has to be a negative and these positive. So why don't you try and solve that and tell me if you get the yield of 6.5%. Let me know how it goes. So N would be 5. PV would be 85455 negative. PMT would be 30 and FV would be 1,000. So this is a discount bond. I know that because this price is less than 1,000. So I anticipate that the payment underpays the interest rate. So the interest should be higher than 30%. I already know that. But calculating it is another thing. So make sure that you use the correct signs. Very good. Okay. Any complaints? Anyone having difficulty? Anouk. Very good. Okay, so there's great value in the financial calculator for solving problems like this. All right, what if, okay, well, let me wait. Let me see if there's anybody else who wants to comment. Very good. DG, fine. Oh, hi. Very good. Nice to see you. Okay, good. All right, so we have, what if we look for a different variable? Let's try and find the coupon rate. So here's a problem. Now the coupon rate should already be stipulated on the bond, but just for completeness, let's try and find all the variables, right? So let's say we know the face value, the time or duration of the bond, the selling price, and we know the yield to maturity. So what's missing is the coupon rate. Keep in mind, don't forget the formula, C times FV is equal to the payment. So I'm writing that because we are going to solve our problem to find payment because we have 1,000. We know this already. So we're going to find payment using our financial calculator and then solve for C. That's the approach that we're going to take. Very good, Harry. So shall I leave you with that for a minute? So work on that. Let's take a bit of a break. So work on that. I'm going to take a 5-minute break. Okay, I'm back. How'd it go? So what you should do is present your formula. There are two parts, right? So never forget that. With the bonds, you use all the buttons, all the keys of the TVM row, and you use two formula to get it. So this is the formula you would have to write in a test situation or assignment. The price is 900. This is the face value. This is the yield to maturity and the term of the bond. And this time, be careful again. Make sure your signs are correct. These should be positive, and this should be negative. That was very messy. Let me try that again. I'm writing on glass, literally. Here, this is negative, and this is positive. These are positive. You ask for the payment. You know 5 is N, 8 is interest, negative 900 is the price, because that's what is paid to get a commitment of $1,000 face value and intermediate payment. So now you can figure out the payment. There's the payment. And now convert the payment into the interest rate. Sorry, the coupon rate. So that's how you do it. Very good. So make sure you follow any directions or instructions I have for you if I want you to hand in some work about this. The instructions will tell you how many decimal places to provide. Okay. Let's see what's next. I'll give you a moment to check that. Any questions? I got to be very careful with the sign. Very careful, or you'll get an error. You will get an error if you are not careful with the signs. Okay. Next. All right. So I'm going to suggest, in terms of the formula sheet, you should add to your formula sheet, you should put here annuity due. So you should just build on top of this so you can have a summary of all the formulas you need, okay? So you should add here the annuity due formula, and you should add the bond formulas. Okay, just so you remember that there's two parts. There's the annuity and the present value of the face value of the bond. So you can just keep adding formulas that, well, there's other formulas that goes with bonds. Also this fact that payment is equal to C times FV. You need to remember that. So start building formulas all on one page, right? It's very useful than having to flip through your notes. Okay, let's continue. So the last formula on the formula sheet is the annuity with growth. Now this one, the annuity with growth does not have has not been programmed into the calculator. Okay, so it's not programmed into the calculator. You have to enter this by manually. So I will practice that with you. Here's an example with the timeline. The example: Angel can purchase an annuity to receive 30 years of supplemental pension payments. Okay, so Angel can buy an annuity. You can buy, this is a product of insurance companies. You can purchase an annuity, and that will supplement the pension for 30 years beginning next month. So take note. These are monthly payments. When payments are monthly, you need the monthly interest rate. Okay, so the annuity will be purchased for an amount, and then that amount gets invested by the insurance company, and they make some money off of your investment, and you make money off your investment. The promise is that they will pay you 0.5% interest per month, and then adjust it for inflation by 0.2% per month. So your payments will be monthly, and they'll be adjusted for inflation. So inflation is the steady rise of prices that occurs. And in order to keep up, if people are receiving fixed income, they need to be compensated for changes in prices, or they won't be able to buy as much. So this is the timeline. The first payment will be $100, and then it will grow at a rate of 0.002 or 0.2%, and continues to grow all until 30 years. So 30 times 12 is 360 months. So how shall we handle this? This is an annuity, but the payments are growing. There's a pattern here. So I need to start with the growing perpetuity formula and then remove any cash flows that don't occur. So that is going to be how I'm going to derive the formula. So let me show you first the result. Here's the result. It's a very long formula. This is on your formula sheet. And it says that it is the growing perpetuity formula with an adjustment factor. We'll talk about where this comes from, and I'll prove it. But you can only use this formula as long as I is not equal to G. And why is that? Notice if I equals G, the price would be 0 on the denominator here. And it would also end up being 0 because this would become 1, and 1 minus 1 would be 0. So the denominator and the numerator would be 0, which is undefined. So that doesn't work. If I equals g, we have to use a different approach, and I will show you how to do that. Okay, so this formula only works when I is not the same as g. So it's, in other words, if the growth of the payments perfectly offsets the erosion factor of money, the interest rate, you can't use this formula. Okay, let me show you where the formula comes from, and then we'll apply it, okay? So here is, remember this is the timeline for growing perpetuity, and that has a value at time 0 of this amount. And here is the timeline of a growing perpetuity. And the value at time t would be this. So those are at different points in time, and I need to bring them together. So what I will do is discount this amount. Notice where it comes from, because the first cash flow is this one. I have to put that up here, okay? For the perpetuity formula, you have to put the first cash flow up here and then divide by I minus g for the growing perpetuity. So I do the same thing here. I take this value here. Where does this come from? This comes from the growing payments. And then divide by I minus g. So this amount needs to be discounted back to time 0. And I need to subtract it because these are the payments which I will not receive, because the payments are only coming for t periods. So I need to take this perpetuity and subtract off the payments I do not receive. When you do that, you get that formula in the box. You gonna trust me on that? So let's practice applying that formula, because this is a very realistic example, isn't it? That we index payments, adjusting them for inflation. So we need to know how to apply this formula. And I'll give you some more examples of that in this course. So as I was saying, you can only do this. This is bothering me. I'm trying to clean this up. Okay. All right, so let's see. This is the formula in action. It's $100 to be received. I was 0.5%, and G, the growth, was 0.2%. They're not equal, so I can apply the formula. Always remember I is on the bottom, okay? So I goes down here as well. It's a discount rate, discount factor. And so how do I enter this into my calculator? I begin here. You start there and you enter 1.002 divided by 1.005, and you say equal. And then you raise it to the power of 360, and then you change the sign and add 1 and say equals. So I did do this before, similar, but not with this type of problem. I did it with the annuity, not the growing annuity. And then it's easy enough to multiply by 100 and divide by this amount. So make sure you just summarize that value. It'll make it easier when your entry that this is 0.003. So you say times 100 divide 0.003 and then equals. So why don't you try that? So I saved you a lot of trouble. I've created the timelines for you, but in the exercises I've shared, and I'll give you some more to practice with answers, you should make the timelines yourself, okay? Practice making the timelines. Are you able to get that answer? Are you getting it? You're able to get that value? So the result is 21,000. $21,970. 77. No questions, no comments? Have you got the number? It must be entered manually. Okay, try again, Jeffson. Follow my steps. 1.002 divide 1.005 equals. Use the key y to the x, raise it to power 360. Maybe we have to say equals. Maybe that's my mistake here. Okay, let's do that. Maybe that's not going to show up right away. Let's try that. Can't hurt. So y to the x and then 360 and equals. And then change the sign. And then add 1 and equals. So then you have this factor, adjustment factor, multiply by 100 and divide by 0.003 and equals. Try that. Okay, great. Jeffson got it. How about the rest of you? I'll give you some time to punch it in. Again, the other alternative, you could use Excel and type that in there. But I want you to get to use your finance calculator. It's easier, it's handy. Or if you got it on your smartphone, it's great too. Okay, if the screen gets blurry, remember to refresh. All right, I haven't heard from anyone other than Jeffson. Does that mean you're working on it? So what we have to do next is deal with the case that I is equal to G. If the interest rate and the growth rate are the same, what should we do? So here's an example. Just give me a moment. It sounds like there's a protest outside. Hold on, I want to check on it. Very good, Monsieur Sever. I'm glad. All right. Ready? Harry got it. Very good. Yeah, I think Jeffson is just some party, really. I heard police cars and just lots of noise, music. I think it's still there, so it's just a party. Anyway, you are considering a deal where you will receive $100 for 4 months starting next month, and each month thereafter the cash flows will grow by 1%. So notice the payments are monthly and the interest rate has to be the monthly one. Notice also that I have included a growth rate of 1%. Okay, so there's growth of 1% and then interest is 1%. So this is the timeline. This occurs as a short 4 months. But I wanted to make this example clear. So here you go. Here you see what's happening. The first $100 you discount for one period. The $100 at period 2 you would discount for 2 periods. This is what you have to do if if the formula doesn't apply. And the formula doesn't apply because I equals G, right? So if I discounted 1.01 for 2 periods, what happens? So this is this cash flow, and I discount it for 2 periods. What happens is that this cancels with one of those. And you just get $1.01. So that looks familiar. Deja vu, it's right here. And this will happen all the way down. This amount at 100 with 2 periods of growth will be discounted 3 periods. So it will be 2 of these will cancel with 2 of those, and that will leave 1 on the bottom. So this is identical. So again, this is what you have to do if the formula doesn't fit. You have to use first principles. Okay, and the last one will be the same. Three of these will cancel with 3 of these, leaving 1. So the answer to this problem where I equals G is a different formula. We see a pattern here. It looks like if I equals G, the present value of these cash flows would be the present value, it would be the C1 over 1 plus I times T. Maybe that's not so clear. Let me do that again. I'm going to make this bigger and do it. So the present value is equal to 4, but in this case, in general, it would be T periods times C1 over 1 plus I. That would be the general formula for this setting. Where I equals G. Okay, so it's a different formula. You can't use the original one because it deteriorates, doesn't work. And how much do you get? I'm not sure why you got 40,000. It should just be 4 of 100 divided by 1.01. And again, this is because I was equal to G. We couldn't use the growing annuity formula, the big one. So this is another one you can add to your formula sheet. Remember to stipulate the terms. Any questions? We have just a few more slides. So you've learned about stocks and valuing stocks. You've learned about bonds and valuing bonds. We learned about determining different variables from, rather than valuation, finding yield to maturity of a bond or required rate of return of stock. We learned about different types of annuities. So these annuities, either you can actually buy a product called an annuity, or you can use the annuity formula when you're talking about payments. Payments can be indexed for inflation, and then you use a growing annuity formula. All right, so you guys got this? Let's look at the pension problem. This will be the last thing we do today. And I'll send you a series of documents for tomorrow. Imagine if you wanted to save for your retirement and you put $3,000 away per year for 30 years into a fund earning 12% per year. So the number 12% is used because historically, over time, the return on the stock market is an average, the American stock market is an average of about 12% a year. And so that number was used here. Let's say you put your retirement savings all into an interest earning fund at 12%. That's very high, very hard to find right now. But you could find it in risky investments. So that's why the number is 12% there. It's to mimic if you were investing in the stock market over a long period of time. The stock market goes up and it goes down. And more people have been participating in the last years since the internet, but it continues to be about 12% average, even with the crash of the market in 2008. And it's still, overall, it's about 12% on average per year. So at the end of the 30 years, you would like to receive 20 annual payments starting 1 year thereafter. The question is, if you invest like this, investing $3,000 per year for 30 years, how much can you withdraw? Very practical question. Very important question. So what we're talking about is building a fund, putting cash flows into the fund. I mean, these are actually out of pocket, but they're going into the fund, and then you're going to withdraw them from the fund. And I want to know what the payment size could be for withdrawals. And these withdrawals take place every year, end of the year. Okay, so what we see here are two annuities. First, the annuities going into the fund and then accumulating to an amount here that is later withdrawn from in the future. So in this perspective right here, this is where I want to solve these annuities. I want not the present value, but I want the future value of these deposits, and then I want to use the accumulated amount here as the present value of these withdrawals. So there's two larger steps. So the cash flows going into the fund would be this annuity here. $3,000 at 12% annuity. So if you punch that into your calculator, you should get this amount. This is the present value, however. What we really want is the future value. We want to know how much it accumulates to. So let's enter that into our calculator together. Then I will call that amount here the present value at time 30. You see how I changed the subscript? So that will be the present value here, from which I draw another annuity. This is the annuity of payments. So I know you've done a lot today, but it's going to culminate in this. Let's just do this and then we're going to go, right? So let's see. Let's take some time to do this together. First step. Let's enter the amounts to find the future value of the deposits. So let's go to the calculator. Well, we have to write it up first, right? Let me go back and show you how we would write it. We would write this as the present value, and then this is the future value. So it has to be in two parts, because I want the fund, the value of the accumulated fund, here. $30. All right, so N is 30, 12 is the interest rate, and the payments are $3,000. Let's put that in the calculator. So let's go to second, clear TVM, and I start entering 30 into the years. The interest rate I said would be 12, and the payments are 3,000, and we'll say, oops, they're out of pocket, right? We'll put a negative on it, and that goes into payment. And now, first I'll put 0 in future value, and I'll ask for it to compute present value. That's the present value amount, 24,165.55. But that's not as interesting to me. What I want is the future value. So let's get that. Second. What did I just do? Not second. No, I don't want that. I want compute FV. That didn't work. I have to put 0 into PV and ask to compute FV. This is what I want. So in present value terms, the amount is 24,000 some. But in future value terms at 12%, that amounts to $723,000. That's $723,000. So let me do that again. So we put 30 years, 12 is the interest. The amount I'm depositing, or someone's depositing, is 3,000, so that's a negative. And I'm going to put 0 in future value to begin with, but then ask to compute the present value. So this represents the present value of those future cash flows, accounting for the time value of money. But I really want the accumulated amount. I want to convert that into, I'm going to first put 0 into PV and convert that into the future value. That is 723. So what I'm going to do next is store that value. I'm going to store that value because I don't want to do that again. So let's go back. Let's see what we've done so far. So we did this where I calculated this $24,000 amount. That's the present value, but then I want the future value. Future value means I would have to take that lump sum and accumulate it here. So try not to get confused. Like, these payments collapse into $24,000 right now. That's what it's worth. This annuity is worth $24,000 today. And I really want to know, if I had $24,000 today with 12% prevailing interest, what is that worth in 30 years? Well, it's $750,000. $12% is a high interest rate. If you can get it every year. All right, so next, we put that amount here, and now we make it an annuity from which we want to determine what the size of our payments are. So next step is for 20 years of withdrawals, still using the 12% interest rate. It didn't change. In reality, it could change. And then we're going to recall our 723,000 from our memory and ask for the payment. So you just need to remember 20 periods, 12 is the interest rate. So I'm going to clear this, and I'm going to say there's 20 periods of withdrawals, and 12% is the prevailing interest rate. So the fund continues to earn 12% interest, okay? It doesn't stop earning interest. I want to figure out how much I can withdraw if the present value, recall 1, is $723,998.05. And notice I keep all the decimals in. I do not round it. in this step. So what I want to calculate is not the future value. I want to put a 0 in there. I want to ask for the payment. So with this, in this exercise, you found that for 20 years you can withdraw $100,000 a year, or 96,927 and 98 cents. So I would like you to practice doing that. I'll stay here, and this will be the last exercise we do tonight. So I'm here if you have any questions. Great, Jefferson. So happy. And you use the storage button? Very good. How about the rest of you? Very good, Hanuk. Excellent. Okay, so the main thing here that might trip you up is realizing that, and don't forget this, if you, in a test situation, you have to write this down for me, the whole thing here. That, let me clean this up. You've converted the present value into the future value. This is the basic time value of money. This is not something new. This is the basic time value of money formula. So we've covered a lot of ground because we haven't had to write all of this up. But it's really important that you try as many exercises as possible. So let's make sure you get this, and then I'll take your questions. Any questions? I feel like we should spend 15 minutes doing something. If you have no problems with this, we should do a little more together. Okay, so what Harry asked, why did I put FV? Because here, remember when the only place that you use all of the keys is in coupon bonds. So in solving this, you've entered PV as this amount. So you have to put 0 in future value. Okay, because you are now solving, this is acting like the present value of these future cash flows. So even though it was the future value, so it's all about this. It's the future value to the past, but it's the present value of the future. And that's why on the page before, I made those equal. They're the same thing. So if I'm referring to the cash flows in to the fund, I'll call it FV30. But if I'm referring to the payments received or withdrawn, the amounts are withdrawn, then it will be PV30. But they are the same thing. And you do have to put a 0, yes, it won't work. Remember, only with you have to choose. In annuities, either FV is 0 or PV is 0. You can only solve for one of those or use one of those at the same time, not both. Only the case of coupon bonds do all of the keys have values entered in them. I think this should say 0 into FV. Maybe that might be confusing you. Right, Harry, that's correct. Yes, FV equals 30, FV 30 equals PV 30 because of the fund accumulating from deposits, and it's the fund from which the withdrawals are made, so they are the same thing. Every position on the timeline has two perspectives. It has the past and it has the future. So yes, you have to put FV 0 into FV. If you look back at all our problems, if we were calculating PV, we had to put 0 in. If we were calculating FV, well, this is the only place I've actually calculated FV. You put 0 in PV. So, yeah, I haven't calculated FV for annuities until here, I think. And this is the formula here. So I think it would be important to write out this exercise step by step for yourself. It's a really good example. Okay. So to recap, we deposit $3,000 every year for 30 years to accumulate a fund. With that fund, we want to make withdrawals for the next 20 years. How big can those withdrawals be? And that's what we've sorted out. Any more questions? So, for tomorrow, I would like you to, I'm going to let you go now. I want you to work on the handouts I gave you. You can spend, I don't know, if you can spend some time tonight, an hour, even a half an hour, and work on those handouts. I will send you the solutions in the morning, and then we will talk about the solutions, and I will have sent you some more material, okay? So we'll have many exercises to work with before I give you your test, or we call it the assignment, at the end of tomorrow's class. How does that sound? So I'll see you tomorrow morning at 9 a.m. Unless you have any questions, work on the exercises that I sent you. Just writing a note to you. And I will send you the solutions so you have them. Okay, so I don't want to burn you out with more material. I'll just talk about these tomorrow, these last couple pages. Thank you. So I already sent exercises, so just study those exercises tonight. Spend some time tonight, not too much, you need some rest, to solve the exercises I sent you. And we'll review them together. Those are just homework. They're not for submission. And then after the class tomorrow, I will give you your assignment for the week, okay? Good night. Bonsoir. Good luck. You didn't receive it? Can you email me, please, if you didn't receive the documents? I send them to everyone. Please email me if you didn't receive the documents. I had trouble with some email addresses. Okay, Francette will send it, but I should get your email correctly. All right, send me an email so I have your email address. Send me an email. Thank you. I do need some rest. I'm really tired. You too. Have a good rest. Samuel, you're not getting the result? How far do you get? Good night, Harry. Bonsoir, Francette.